Hi, it's Jeff Waite here at stockideas.org. Today I'm just going to quickly talk about the difference between the book value and the market value of stocks, and then I'll show you how to use this to your advantage in picking stocks with a stock screener. So we'll start at the market value, or the open market value, which is also known as the fair value. And it's basically just what you can get on the open market. If you put a market order into your brokerage, what you get paid is the market value at that second. It's always changing. It's the commonly quoted price of the stock. That's what the market value is. The book value, on the other hand, is the value of the assets, goodwill and patents and other intangible assets are included in the book value. So the best thing to look for is tangible book value, which will be just the cost of all the assets the company owns minus any depreciation, etc. So this is often a good value of what the company is actually worth. If you were to break it up and sell it and get full value for all its parts, this is, the sum of that would be the book value. So, a lot of value investors will buy stocks below their book value, especially if when the market value is below the book value. That indicates that there's a discount and there might be an opportunity to make some money. So I'll show you what that looks like in more practical terms. So I'm just at finviz.com here in the screener, and if you go to the fundamental tab and you go all the way over to the right here, you'll see this price to book. And this is a ratio that compares the market value to the book value. So you divide the current closing price of the stock by the last recorded book value per share. So if you take the book value and divide it by the number of shares, you get the price per book. Now, ideally, if you're a value investor looking to buy stocks on the cheap, you want a low book value, so a book value under 1, and that means the company is trading at, anywhere from, if you go to FinViz, you can screen it, and if you click on the valuation tab here, you'll see price to book, and you'll see companies that are trading at 0.79, so that's 79% of book values. Alcoa, I guess. Yeah, wow. 66% of book value. Over here, this oil and gas company, that looks good actually. I really own AEG right now. So you can see that, there are 972 stocks here that present a real bargain. Of course, this is only one criteria, and there are tons of other criteria that you're going to want to screen for, but this is a really great starting point to find stocks that are really cheap. Conversely, if you want to start shorting stocks or buying puts, if you're into options trading, this might be a good place to start as a high price to book. So these companies are trading at 5 times what their assets were. So like AAMC here, I don't know anything about it, but it's trading at 590 times its price to book. And it's just exploded in the last year, and maybe the book value hasn't updated since something's happened. It might be an anomaly here that's not reflected since this is the last quarter. This is maybe more typical, but this isn't unheard of. You can see there's still a lot of companies with 11, 7, 9, 11, 8 times book value. So these companies are trading well below what they're actually worth. So that means there's not a large margin of safety. When you're buying a stock that's trading for 50 cents on the dollar based on the price to book, there's a large margin of safety. You know that at some point this is probably going to revert to the mean. Maybe not on a $26 million market cap company like AEY, but it's the same thinking. And alternatively, when a stock is trading at 11 or 22 times book value, if there's something that's going to interrupt this free cash flow or the earnings or even the earnings growth, if something changes there, these stocks could really take a haircut, and there's no asset value. No value buyers are going to step in and provide a floor to the stock price. So that's why you want to be aware of price to book. You want to understand market value, the fair value, what you're going to get for it. Book value is the what the assets of the company are worth. Ideally, you're looking at tangible book value. And then over on the stock screener here, you can use the valuation tab and the fundamental book value tab to find stocks that are exorbitantly overvalued relative to their assets, or are actually selling for less than their assets are worth. Acre here is selling for 35% of the assets on the book. Maybe there's a lot of debt or something. There might be a reason for this, and there often is a reason, and you're going to want to dig into that and do your own research beyond just this screen. But this is a really good starting point to find well-run companies that have been discounted by shareholders. Thanks a lot for watching. If you have more questions or are curious to read anything, check out stockideas.org for lots of stocks, trading, and investment ideas. And feel free to subscribe to my YouTube channel as well for more videos. Thanks a lot.